The world of finances is changing, and it's changing in ways that honestly a lot of people didn't expect or wouldn't even have known to predict. Because for untold decades, paper currency is all we have used. But now, cryptocurrency is slowly starting to make people rethink that very premise. To the extent that there are whole swaths of cryptocurrency to go and invest in if you have the money and time and will. But that plethora of options can go and lead to major mistakes if you try and buy in. So, with that all being said, I'll ask to show you cryptocurrency investing mistakes to avoid. Be sure to like the video and subscribe to the channel.
To thank you for watching this video, we're offering you an absolutely free training webinar. Have you ever wondered how to end procrastination and self-sabotage so you can unleash your full potential to live the life you deserve? #1 best-selling author and high-performance coach Peter Sage is hosting a free webinar where he'll teach you how to increase your wealth with less time and struggle, and also how to hyper-boost your growth and success so you can finally break out of any rut you find yourself in. Right now, Peter and his team are offering a free $100 gift to anyone who doesn't find his webinar as the best use of their time within the last 5 years. Now, let's get back to the video.
7. Putting all your eggs in one basket. It's one of the biggest mistakes most new investors make. If you want to play with crypto coins, it's wise to consider spreading investments across multiple diversification strategies. Investing big on one coin can ruin your wealth and future investing plans. Portfolio diversification is widely held as a timeless strategy to migrate the risk of major loss. Beginners often believe that every dip in coin price is a buying opportunity. They also sometimes think about buying on the bull run is a good strategy because the price goes too much higher. In these cases, investors are at risk of losing capital. It's key to understand the reasons for buying any bull or bear run before initiating a big position. Furthermore, using leverage for playing with the crypto market should be deployed with extreme caution, and only if you're an expert. That is because of the high level of volatility inherent in emerging digital store of value. The digital coin market has the potential to make or wipe out hundreds of billions of dollars in a few hours alone. The latest price crash is a perfect example of the crypto market volatility. 6. Not identifying your investor profile before starting to put money into the game. In the world of crypto investments, the players who do not take the time to identify their investor profile and strategize based on it are bound to lose. In layman's terms, these are the 3 main profiles that investors may identify with: conservative, moderate, and trader. The conservative investor, also known as a hodler, never wants to be exposed to risk. Typically, such a player's strategy is mostly based on holding an asset he or she considers valuable, based on a long-term appreciation plan that differs from the current cryptocurrency price. Nowadays, most investors in the crypto industry are moderate, which are individuals who have built different positions in their portfolios. A little bit of variety in terms of assets that follow distinct strategies that involve both trading and holding. However, the individuals who make more money in the crypto industry are the traders. A trader is an individual who surfs on the crypto market fluctuations to profit on short-term operations. Even though trading may sound attractive, it does involve plenty of risks and a large amount of knowledge to avoid losing money on clever strategies. So know and show who you are before going and doing anything, okay? 5. Private key loss. Perhaps the biggest mistake in a potentially lucrative investment is to be totally locked out of accessing those assets. While a cryptocurrency wallet looks like a straightforward app, it is also quite unforgiving about passwords. A wallet is specifically designed not to divulge its private keys easily, or it would defeat its own purpose. So, unless a user has arranged some form of backup, wallets never offer recovery. In the early days of BTC, private key loss and locking up coins was an honest mistake that happened often. Wallets relied on a file storage on the computer, and the loss of corruption of data led to losing the coins. Because BTC was an experimental asset, or its price was relatively low, early adopters were less careful about preserving their coins, passwords, or other authentication data. Later, wallet versions use a seed phase, and can display the private key to an authorized user. Usually, the best approach is to safely store a paper copy of the seed phase. To further diminish risk, it is possible to generate several wallets and never store a significant balance in one single wallet.
To thank you for watching this video, we're offering you an absolutely free training webinar. How would you feel knowing that you could pay every bill you have right now as well as any future bills that come in? Commission Hero is a proven system that has helped over 8,000 people earn upwards of $1,000 a day or more. The best part is that there is zero experience needed to get started. In this free training, Robbie Blanchard and his team will teach you the top 3 secrets to how and why this system works, and how it can also work for you. Join the thousands of people who have found success and financial freedom using Commission Hero. Right now, the first 100 people to use the link below will get access to this free webinar. Now let's get back to the video.
The aim of BTC is to make every user their own bank, but that task comes with the added layer of responsibility. Hardware wallets are another tool where care should be taken to avoid password, PIN, or seed phase loss. A feature on PIN entry for hardware wallets extends the lag time after each attempt, making it easy to lock oneself out of a wallet. One cautionary tale of a notorious user tracks the disaster that may follow after getting locked out of a hardware wallet. 4. Make your exit strategy before buying. Buying any asset, particularly a digital coin, without having an exit plan could be a disaster. You must have your stop losses in place and a mental framework planned in advance to accomplish your primary objectives. One cannot let the losses mount if the market environment keeps getting tougher. Exit strategies help investors to mitigate extreme losses. On the other hand, an exit strategy is always key, even if you're winning the bet. Investors who don't have a deep knowledge of market psychology could also lose their money when they don't sell on the rise, due to expectations for further price growth. Knowing about the appropriate time of selling is the best approach for capitalizing on gains or squeezing losses. 3. Not having a clear and thorough plan. Not planning ahead is the worst thing a crypto enthusiast can do while investing/trading cryptocurrencies. A decade ago, you would only need an average home computer to mine an amount of Bitcoin that would be a fortune today. However, nowadays the words competition and cryptocurrency are almost synonyms, which means profiting in the crypto market is a newbie task. You need to be strategic and establish clear goals before making any decisions. The chances of financial losses are even bigger when you don't know where you want to go. Hence, you must determine your goals, your desires, and only later get into the crypto game and start profiting with digital assets. This arguably is one of the most important flex pause to not only do because of how vast the cryptocurrency market has become. So, think of it like this: investing in the stock market or trying to start your own business. You shouldn't just rush into those, right? So, take your time, think things through, and make things work for you. Else, you're going to be losing a lot of money. 2. Investing in fake coins and tokens. Not all assets carrying the BTC ticker are actual Bitcoin. During the boom of altcoins in 2017, a new type of project appeared, the platform coin. Platform coins could generate tokens and also perform simple exchanges. Because of the heightened interest in BTC trades, platforms like Waves, Komodo, and Next started offering the tools to emulate coins and tokens. Almost immediately, tickers appeared that spoofed real BTC, ETH, and other leading assets. Decentralized exchange are one of the hotspots for potentially faked assets. Decentralized exchanges are simply software that runs on the Ethereum blockchain, allowing for trades to happen through an algorithm, even avoiding order books. These exchanges offer a ticker and a price, but there is no central verification of the underlying asset. As altcoins and tokens become too numerous, not all can find a place on curated centralized exchange. For that reason, automated protocols may replace the user approach of order books and an order matching engine. To avoid losses, it's best to explore how a coin or token will gain liquidity, or who may be interested in trading the asset. 1. Buying on speculation. Buying on speculation is the worst mistake many beginners make, and this can often lead investors to buy high and sell low. Many newcomers just want to ride the rally and make profits without thinking about the future prospects of the coin, or what factors are actually driving the coin's price higher. Earlier this year, speculation about the massive level of crypto adoption, as well as broader crypto market rally, have pushed both retail and institutional investors to buy various coins at a higher price. Crypto markets are volatile, and it's quite difficult to predict the future price movement. Investors who have bought digital coins on the recent surge lost money this week, following a surprise collapse in crypto markets, which is blamed mostly on a ban of Bitcoin from Tesla. Increasing Chinese regulations and uncertainty contribute to the sell-off. Plus, as recent times have reminded people, the market can crash. So if you're riding a wave, you might just find yourself crashing upon the shore. So what do you think? What do you think of this look at the cryptocurrency mistakes you want to avoid if you start investing in them? Does hearing these things make you feel more comfortable about doing these kinds of things? Or does it make you even more nervous about getting involved in cryptocurrency? Are you already an investor? Let us know in the comments below. Be sure to subscribe, and we'll see you next time on the channel.